Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 39th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're calling this one Fed, I Don't Believe You. You a fan of Ron Burgundy? That's a play on Ron Burgundy, by the way.
Yes.
You like him?
Yes. No, for sure. And are we saying I don't believe you? We don't believe you.
I don't know. That's a good question. Maybe we need to change the title. I was going with I Don't Believe You because that's the Ron Burgundy quote. So I guess I'll stick with what Ron said.
No,
But we could
good.
internally on this podcast say we don't believe you either, which we'll talk about. But we're happy to be back. Obviously, last week had a recorded one with Larry Sprung. Hopefully you enjoyed that. So Sonu and I have a lot to talk about. As usual, try to keep this 30 minutes. We'll see, because there's a lot of stuff going on. Even before we started, Sonu's like, hey, housing data just came out. Let's talk about that. So we've got a bunch of fun stuff to talk about. But Sonu, first things first, last week, again, we didn't have a podcast, but you and I hung out. We met in Columbus and went to Thurman's, which if anyone's ever heard of Thurman's or been there, it's one of the famous burger joints. You see it in all the shows. I kind of want to go back. That was awesome, wasn't it?
I would like to go back every day, every week. No, for not good for your health. But no, it's fantastic. Oh my God. It's like should we explain what it's like? It's like this little dive. It's a little dive bar. I mean, it's not a bar. It's a burger joint, right? It's a burger joint, but they don't have milkshakes. It's not that kind of a burger joint, right? But they have pretty spectacular burgers. And I got to hang out with Ryan and his son, who was there for a football camp. Was it, Ryan?
Yeah, the very next day. So what did we do this last Monday? So the Tuesday, there was a 7-on-7 camp at Ohio State. So it worked out. You were there. My son and I went up, and he had a 7-on-7. They did well. They made the semifinals. They lost to a really good team, but it was fun. It was a fun 24 hours in Columbus and got to eat a really good burger. So let us know if you've ever been to Thurman's. It's right up there with
maybe someday we can do the podcast from there. I don't know. Or
we did a video. Yeah, that'd be good. So, well, Sonu, let's just jump in again. We're calling this one Fed, I Don't Believe You. We're going to discuss the Fed decision last week where the Fed came off hawkish, but nobody's believing them. We'll talk about why we feel that way. Then kind of an economic roundup. We'll look at inflation. We'll look at retail sales, and then they just released housing data as well. Then we'll finish it up, depending on how much time is left, on just some really interesting statistics and stats we've seen on the stock market. I've been sharing them on social media and different blogs that suggest there's been a great rally, but there's probably a lot left in the tank, which is the good news. All right, so Sonu, the Fed, I'll set the stage and hand it over to you. 10 rate hikes in a row. They finally paused. They took a rest. It was called a hawkish pause initially, but then the next day, the stock market went crazy, and everybody said, you know what? The Fed is done, and that's the playful title we have with Fed, I Don't Believe You. You've had time to think about it. What's your take on what the Fed said, but more importantly, the market's reaction to what the Fed said last week?
Right. And when we say stock market went crazy, it went up. So good crazy.
Yeah, good point. That's right. A touche. Crazy to the upside, which I'll just add this real fast. Remember last year, the Fed would do anything. Well, I guess they'd hike. What they do last year, they hike. And usually the market do okay. It was that next day we came in. It was a bloodbath. Stocks would get crushed the next day. People slept on it. This time we slept on it, had a different reaction, which I'm all about the reaction to things. And that was a great reaction. But yeah, so to add to that.
Yeah, no, look, I was actually pleasantly surprised, and I say pleasantly because markets went up, right? With what happened on Thursday. The Fed meeting was on Wednesday, and I'll talk about that. But the market reaction is always interesting, and markets went up a lot, right, on Thursday. I forget I'm sure you have the exact numbers, right? So it was almost like a real nice confirmation of the story from the previous day, and especially as like everyone, like beyond me, like you and I, and everyone had time to sleep on this, and they decided, oh, you know what? Things are okay, right? So let's talk about what happened on Wednesday with the Fed meeting. They paused rate hikes, as you mentioned, first time after 10 consecutive meetings of raising rates, right? But this was expected. The big story was, I'll put it this way, look, the Fed every 3 months, so March, June, September, December, they
I was
update
going to see if you could get that right every 3
Yes,
months. I was thinking,
I
hey,
know.
what are every 3
Every
months?
3 months.
Harder. It's
Yeah.
harder than it thinks, everybody, when you got the
I know.
camera on and recording. I don't want to mess this up.
There you go.
Yeah, nicely
We can-
done, Sonu.
No,
Yeah,
thank you. So we can always edit it, but
that's true
no,
too.
this is a first take thing. So just so that all
I
of
said, if we ever edited anything, I don't know. We're kind of a just
I
turn
don't
the
think
camera on
so.
and roll type
I
of guys,
know.
unless
I
we
don't
say
think
something really wrong. But yeah, so
I
far
don't,
so good there.
so
Anyway,
far so
yeah.
good. But yeah, so they update what's called a summary of economic projections, right? What they're in their view, what they think the economy is going to do, real GDP growth,
Mhm.
unemployment rate,
Yeah.
inflation. But most importantly, they tell us what in their minds, what interest rates will be,
Hmm.
at the end of 2023, end of 2024, 25, long run, all of that. And the big story on Wednesday, as soon as the materials are released, was that, oh, they raised the rate for 2023 from 5.1% to 5.6%. That's a big jump. That's
And
0.5%,
is that the
50
terminal
basis.
rate? That's when we hear terminal rate. Is that what that is?
Right. Yeah, terminal rate, because that's, the highest rate they expect. And then
Mm-hmm. Yep.
2024, that's expected to go down to 4.6%. And this is
Okay.
everyone is like, oh, wait, this is really hawkish. And it is, right? If
Hmm.
they're taking their own
Sure.
expectations up by 50 basis points, 5.5%, that would be, that's huge, right? And now let's think about this for a moment. And I think this is where everyone is like left scratching their heads. Wait a minute. You've gotten more hawkish. You're telling us 12 out of 18 of them think at least two more rate hikes are needed, right? There are 18
Right.
members on the committee. 12 of them thought, okay, two more rate hikes are needed. But
Hmm.
wait, if you think two more rate hikes are needed, why pause now, Ryan? I like, why
Yeah.
pause? If you think, oh, the economy is overheating, there's a risk of overheating, we need two more rate hikes. Like, wait, why pause now? Why not just get control right now of the situation, right? That didn't make any sense. Right. Then the other thing is, I just talked about 2024. They said the rate's going to be 4.6%, which is 1% lower than the 2023 expectation. It's like, wait, they are raising rates by 50 basis points and they're projecting, 100 basis points or 1% of cuts in 2024. What's going on?
Hmm.
None of this really makes sense, right? I think what was happening basically was they were so the Fed, I think, has two camps. There are the doves and the hawks. I mean, without
Yep.
getting too much, we don't know what's going on, right? I'll condition everything on that. We have no idea what happens in the discussions. I don't think most people who are outside of the committee has much of an idea of that. But generally, I think, looking at all the material stuff like that, it seems like, okay, the doves are like, inflation's coming down. We need a pause, right? We'll be raising rates a lot. We need to find out what the effects of these,
Right.
500 basis points in rate hikes have been, like 5%. We went from 0 to 5. What's the impact of that? Let's wait a bit. And they got that pause. But in exchange, the hawks, the folks who want to, put the brakes on the economy a little bit more, they were like, no, we need rate hikes. Okay, fine. We won't raise rates this time, but let's project that there will be two more rate hikes in the future. Right. I think there was a little bit of a dance between both the doves and the hawks on the committee. Then the other side was, them telling markets, don't expect cuts here, folks. Rates are going to stay
Right.
high for a long time. I think that's what, that's how I'm kind of reconciling all of what happened. And the other big thing, they raise, like I said, they do economic projections, right? In March, their projection for the economy was 0.4% real GDP
Right.
growth in 2024. They raised that to 1%. That's a big jump, right? And long story short, they're basically saying, we don't think the economy is going into a recession or a really, big slowdown here, right? They're acknowledging economic strength. And more importantly, they think inflation can come down without them crushing the economy. I think that's good news for everyone.
And excellent summary there. I'll jump in. Remember last year when good news was bad news or bad news was good news, and you're just confused what in the world's
Yes.
going on? Well, this was good news. The
This
Fed
is
said,
good
"Hey, the
news.
economy's getting better. Inflation is coming
That's it.
back. Hey, maybe we'll do another hike. Maybe we won't." But the bottom line is the market took it as good news. We had a
Right.
6-day win streak on the S&P ending on Friday last week. We're in the middle of a 5-week win streak on the S&P. Literally, the time we're recording this. So those are some, I think, positive things. And again, let's just reiterate something here because you mentioned it. 12 out of 18 saw two hikes coming. the rest of this year. No one saw a cut out of those 18, and only 2 are saying no hikes. Again, that was the hawkish thing that came out initially. Markets sold off. Then Jerome Powell during the Q&A kind of put a little bit of water on that and said, we're maybe not quite as hawkish as maybe what the dot plots are saying. And I'll just put it like this. I love to watch the U.S. dollar on days like this. U.S. dollar was a little weak on this day. If the Fed was truly hawkish, which we were told they were, the dollar might have showed that. And you did a great blog the next day talking about why maybe the Fed wasn't as hawkish as everybody thought. And again, as everyone slept on it and came in, a big rally on Thursday across the board, really strong rally on Thursday. And again, that's a nice difference from what we saw last year, where we just have a bloodbath the day after these Fed rate hikes. Well, Sonu, I mean, great discussion. Are any final comments on the Fed before we move forward into inflation, which is kind of 2.0 to this whole conversation?
No, I think like you said it, right? Good news is good news, right? Big picture is we've had a string of strong economic data and the Fed paused.
Yeah.
That's it. That's good news. Right?
Not so bad. It's not so bad at all.
Just keep it at that.
There we go. Well, so we're going to talk again about inflation, the retail sales, and the just released housing data. But I want to take a little break for a second here. Some other good news. Sonu, I know we talked before about, I think it's called Tulsa King, this Sylvester Stallone show. I think it's Paramount. I think it's Paramount. But I watched FUBAR with Arnold on Netflix.
Wow.
Absolutely loved it. Now, here, I'll just say this. I read some of the reviews. The reviews are like, it's ridiculous. It could never happen. It's over the top. Yes, of course it is. That's what we're watching it for. I just thought it was the most over-the-top, ridiculous show of all time, but it was amazing. Have you had a chance to watch it yet or not?
No, it sounds like I need to watch that. I've been watching this show called Last of Us on HBO, which is depressing. It's about
that's a little serious.
Pandemic.
Okay, yeah,
yes,
yeah.
I need to watch FUBAR, so
this will bring you
up.
It's hilarious. I mean, just anyway, I'll just leave it at that. So if you had a chance to watch it, I think I always liked. We talked about this before. I liked Sylvester Stallone a little bit more as a kid growing up. So maybe I like Tulsa King a tad more. But it's just really cool to see these guys that we grew up watching movies from doing these 8 to 10 episode series that are out there now, seasons, and it's great. They left the door wide open for the second season, and let's just say I was a fan of FUBAR, and let us know if you liked it. And a lot of people liked it. Again, the reviews might not have been so good, but what are you looking for? An Emmy, an Oscar? I mean, what you're watching? Come on now. Anyway, all right. So let's get into the inflation front first. CPI, PPI. CPI is the big one we talk about. So it's down. I think it's 10 to 11 months in a row now. Year over year, CPI is lower. The headline CPI was 4%, a lot better than expected. Remember, it peaked at 9.1 this time a year ago. So we're down almost 5% from where we were ballpark this time a year ago. Core staying stubborn. I know you've talked a lot about kind of why. I mean, let's go that route. Why is core CPI staying kind of stubborn, whereas headlines coming back, and what does it all mean?
So core inflation is inflation excluding energy and food, right? And if you think about, last year, you said it, right? Last June, inflation was running at 9% year over year, right? It's down to 4%. Now we got that. That's a reduction of 5% points, right? Why has that happened? That's come on the back of energy, food, and vehicles, right? Last year, out of 9.1% inflation in June, 5% of that came from energy, food, and vehicles. The rest was about 4%. Right now, energy, food, and vehicles are pretty much zero. The rest of it is still about 4%. That's what you're talking about, core inflation. It's running hot, right? Now, core inflation's, over the last 3 months, it's running at about 5% annualized rate. That's down, right? The good news, let's stay, let's keep the big picture in mind. That's down from a peak of 9%, right? Core inflation. But it looks to have flatlined, right? The good news, it's not accelerating, but from the Fed's perspective, it's like, we need this to go down. What's the problem? It's housing. You and I have talked about this. Housing, at least for core CPI, the Consumer Price Index, housing makes up about 40% of it. Right? And official housing inflation or shelter inflation, that's based on rents, and official rents lag private data by about 12 to 18 months. The good news, again, there's an inflection point right now, and now official rental inflation is decelerating. It's running about 6 to 7% at an annualized rate. 3 or 4 months ago, that was running close to 9 to 10%. There's a strong deceleration there, right? But the thing is, 6 to 7% is still high. We need to get that down to about 3 to 4%. The good news, I think, is, I keep saying that, good news, but there is good news that that's going to come down. By the end of the year, I think we'll be about, or even 6 to 8 months from now, that'll probably be about 3 to 4% maybe for shelter inflation. That's going to bring core inflation down a lot, right? That's going to take a lot of pressure off the Fed. Now, the Fed focuses on something called the Personal Consumption Expenditures Index. It's a little different from the Consumer Price Index, which is what we've been talking about. Core PCE, right? That has a smaller weight to housing or shelter.
Right.
It's only about 18% versus 40% in the CPI index. All this is core inflation, right? But even core PC is sort of flatlining around 4.5%. Now, we did get some good news on this side, right? So there's so many different ways to slice and dice the inflation basket. But the Bureau of Labor Statistics measures something called the sticky price inflation basket, right?
Yep.
Sticky price CPI. Basically, think about this is a basket of goods for which prices don't change too much. It's not very volatile. Prices don't go up and down. Things like food, energy, even shelter, right? They take shelter out,
Right.
and used car, new car prices, all of that is outside, right? It's out of this basket. The rest of it is what's called the sticky price basket. Over the last 3 months, that's running at just 2.5%. It was as high as
Wow.
it was about 7% last March, right? So that bodes well for core PCE, especially core PCE excluding housing when those numbers come out, end of next week or so. Which is why I think even markets, we are talking about people sleeping on the Fed's decision coming back. We just gotten CPI data as well. And everyone is digesting both the inflation data and the Fed looking kind of hawkish, but things not making sense. And they're like, you know what? We'll just go with the data, right? And with what Powell said as well. Look, between now, think about it, Ryan, between the Fed meeting last week, right, and the Fed's next meeting in July, it's just 6 weeks. It's only 6 weeks. How much of data is going to come out? We got one big payroll employment report, and others, inflation report. That's it, right? That's all new information they'll have. They're not going to make up they're not going to change things based on 2 new data points, unless it's something crazy happens, which we don't expect, right? So I think that's why markets are like, wait, you're telling us, you're getting more hawkish, but at the same time, the data is pointing the other way. So actually, an intrepid reporter asked Powell about that disconnect, and he was like, you know what? Yeah, there aren't too many data points before July, so we're looking at maybe 3 months of data. He kind of openly said that we're looking at 3 months of data, which is why I don't think even the July meeting, I'm not quite sure we may see a rate hike. Maybe that's a 50-50 point at this point. It's a coin toss.
Great points. There's a couple other things. I saw household furnishings were negative for the first time since June 2021. Maybe, again, a sign that the supply chains we've been talking a lot about continue to improve. Like you mentioned, shelter came in at 0.6% month over month. Remember, it was running between 0.8 and 0.9 for the longest time. Now we're kind of in that next rung, and we do think maybe 6 months from now that'll be 0.4, 0.3, kind of continuing to lower, which will help everything. Our friends at Bespoke noted when you have a 5% drop year over year from headline CPI, over a year, like we just did, up over 9 down to around 4 now. 1 year later, it's only happened 5 times. 1 year later, S&P higher every single time, up 18% on average. One of the key reasons we've been overweight equity since December. We didn't see a recession, but we also saw inflation coming back. We've seen the history. It says when inflation comes back like that and the economy can stay strong, you can have a really good year. We'll talk about stocks very soon here, and that's exactly what's been playing out. I don't think I had too many more, but just
PPI,
real quickly. PPI, 2.0.
Producer price index.
The producer price came in the day before, actually, down 0.3 in May, expected up 0.1. Core was stubborn again, 0.2 to 0.2. A lot of that was energy, down 6.6%. Food down 4 the last 5 months. PPI, this is wild, was up 14 months in a row from 0.6 to 11.7 year over year.
Wow.
PPI now is down 14 months in a row from 11.7 to 1.1. PPI is lower now than it was before all this stuff started year over year. That is just wild.
That's amazing.
Up 14, down 14. Here's my question to you, Sonu. Does PPI lead CPI? I mean, will that start to flow more? Because we've seen a big drop in PPI, not nearly as much as we've seen in CPI. CPI is down, but not quite as much, obviously. I mean, it's already where it was before all this stuff started. How does that work exactly?
To some extent, yes, generally, but there's some technical things. I mentioned the PCE index. There are things that are in PPI, the producer price index, that feed directly into the personal consumption expenditure inflation basket, especially on the core side of things. So PPI going down is actually a good sign for the Fed's preferred measure of inflation. It's actually less connected to the CPI, other than generally, obviously, they're all measuring inflation in some form, right? The consumer price index is measuring inflation from the household's perspective. PPI measures it from the business perspective, how much a business is paying for the costs of goods that they need to make, products and services, things like that, right? And so I think generally they're correlated, right? The exact, amounts by which they go up and down may change month to month.
Yeah, but I guess the bottom line again, just more positive steps in the right direction on the inflation front. Let's look at now retail sales. You've been one of the bigger macro bulls out there saying, hey, the consumer is still strong, employment is still strong. We will not likely see a recession this year. A lot of people are catching on to that idea, including the Fed, right? The Fed outwardly said that last week. Retail sales again came in better than expected last week. You want to take it away?
Yeah, sales were up. So the expectations were for a drop of 0.2%, right?
hmm
And then it just goes to show how underestimated things are, and how forecasts are just wildly off. Retail sales actually increased 0.3%. In fact, it would have been
Right.
stronger if gas station sales hadn't gone down. And gas station sales went down because gas prices went down, right? It's as straightforward as that. Then the good part is auto sales are really strong last month. It was up 1.4% in May, and that means a few things over there with respect to auto production, right? Production is coming back, which means sales are also going up. Because if you remember back to the pandemic, March and April 2020, right? Production shut down. Zero cars are
Right.
produced. And if you think of how many cars are produced in the United States and Mexico, Canada, all of that, that's a phenomenon. Millions of cars produced each month, and then those go to the dealership lots and sold and all of that. Nothing is produced. So which means there's a lot of pent up demand for vehicles that wasn't there. The vehicles that weren't available because those weren't produced, right? Which is why we saw prices go up, right? We saw prices when new cars go up. We saw prices for used cars go up because people are like, oh, we can't find new cars, so let's go buy a used car instead, right? So there's a lot of demand for used cars, and there wasn't enough supply. So that's why prices went back. We're seeing the reverse of that process, right? We're seeing prices come down for used cars, and even new cars. Used cars prices went up the last couple of months, but generally, I think over the rest of the year they're going to come lower. Production's going up, so sales are going up, right? Because people want these things, want to buy vehicles, and sales are up about, as I said, 6% over the first 5 months of the year. But even take out gas stations, take out autos, even more volatile things like building materials, all of that, which are also strong, by the way, and that tells you something about the housing market, which we can talk about. But take out all that stuff, and there's something called the control group, which is basically the consumption expenditures that go into GDP data, right? That was up about 0.2%, right? Now, if you think, okay, maybe there's a price effect, stuff like that, adjust all this for inflation. Big picture, real retail sales, right? Retail sales adjusted for prices, that was up 0.2% in May. It's still running, Ryan, 6% above the pre-pandemic trend. So basically, consumers are spending 6% more in real terms, price-adjusted terms, than you would have expected before the pandemic. That's a big deal. In fact, that's actually surprising to me how strong goods consumption has been over the last year, really.
No, I think that's surprising. I mean, you've been again a macro bull, but I mean it's surprising even to you. So that tells you how strong that consumer has been. Like you said, a 2.2% month-over-month jump in building materials, also garden equipment. Maybe people are getting out there a little bit, but again, just some positives for sure.
Can I add one more thing, Ryan?
Yeah, go ahead. Go ahead.
The other thing is, we talk about retail sales, right? And we just talk about headline inflation versus core inflation. What's interesting, consumers experience headline inflation, right? The consumers don't it's not like consumers are like, oh yeah, I experience core inflation, but not headline. No, for the most part, all of us experience headline inflation. And what's been happening? Energy and food prices are going down, which means there's more money in the pocket or in the wallets for households to spend on other things, right? And the irony is, at the same time, the Fed is targeting core inflation, which is literally nobody's basket, right? It's not like, I don't spend on energy and food, and I spend only 40% of my costs are in shelter or anything like that, right? So it's this weird sort of situation where we are in, where the Fed's looking at core inflation. It looks like there's not much progress. We talked about why, but consumers are experiencing headline inflation that's coming down in a big way, And so they're spending on other items, on other goods and services in the economy, and that's
Hmm.
keeping the economy strong.
No, absolutely. I'll tell you. You mentioned gas station sales, and we just drove down to Charlotte yesterday, and my boys love Prime. Have you ever heard of this Prime energy drink by Jake Paul? You ever heard of this, Sonu?
And I've seen it. I don't think I've ever
So
tasted it.
it tastes terrible. No
Oh
offense.
gosh. Is it
Yet
like a
it
Red Bull
costs.
sort of thing?
Yeah, kinda. I guess. I mean, but they love it, and all these kids that are always between 12 to 15, they love this thing, and it's like costs a ton of money on Amazon. If you stop at like random little gas stations, you find it. So let me just tell you this: we tried to help gas station sales yesterday, driving
There
driving
you
down to
go.
Charlotte because we had a lot of Prime purchases. So the last thing, and let's wrap up the economic roundup, which again has been positive. There was some. Housing data, which just came out like a half
Right.
hour ago before you and I started to record. You said you wanted to at least touch on it, which apparently is more positive news on the housing front.
I think positive is an understatement.
Okay.
I'm literally looking at the data here, looking at housing starts, right? So these
Hmm.
are, this is data from builders and saying how many,
Yep.
units is starting, both single family units and multifamily units. Ryan, I mean, I have to stare at this with 22% increase in just May. It's not year over year or anything, by the way.
Oh my goodness.
Just
Wow.
May, 22% increase. Single family starts rose 19%. Multifamily starts, rental units, things like that, is up 28%. This is an insane blowout number, right?
Um.
And then you think like I'm looking at permits data. Permits data is like, okay, builders apply for permits.
Yes.
This is even before they put a foundation, anything like that.
Okay. Hmm.
That was up 5% last month, right? And single
Wow.
family starts, which is single family units actually contribute the most to the economy in a sense, right? Because if you go buy a new home, obviously there's design, construction, engineering, all of that that's gone into building that new home, right? And so that contributes to GDP. And then there's brokers, commissions, all those things, sales proceeds that also adds to GDP. And then for a new home, people are usually buying new stuff because it's new
Hmm.
household formation and
Yep.
things, right? As opposed to you going from one home to an existing home, it's a little different, right? Where new homes actually add to GDP a lot more than existing homes. So
Sure.
that's why, if builders are saying we are constructing more new homes, if they're applying for more permits, that's a great sign for the economy.
Yeah, you talked about that a month ago with our partners. I remember you shared the chart of permits, and usually when permits are bottoming, going higher, that's a
Right.
leading economic
Oh
indicator.
yeah.
That's a early cycle
Yeah.
warning. And I know everyone's talking
Right.
about late cycle, but that was one that ran in the face of that. I actually played with
Yeah.
some numbers over the weekend, just reading this tweet I did. This was before the thing you just mentioned. New home sales up 10% year over year and making a new high, 1 year high. I took a look at that. Like, again, spoiler alert, that's not about to go into a recession. You don't see
No.
new 52-week highs or new yearly highs in home new home sales, and just fascinating, continued strong data there. So Sonu, we've got a couple minutes left. Again, I am in Charlotte now. Tomorrow we're going to Myrtle Beach for I think 4 nights. I think it's 4 nights. So that'll be a fun little family vacation. You
Nice.
any family vacations planned this summer for you and the crew? What are you guys up
I,
to?
uh, I we stick around through. I joke that we go through Chicago winters just
Yep.
to spend the summers here, so we tend to travel less during the summer, and we try to get everyone to come to Chicago instead. Like I know I've been trying that with you too, Ryan. But yeah, no, we
That's
have
true.
family
Yep.
visiting and friends visiting, all of that across the next 2 months. So Chicago's an amazing city in the summer. If you haven't
I know.
visited, I definitely recommend. And Ryan needs to get here too. We have a
I
whole
do.
bunch
So
of
I know
burger
I'm.
places to check out.
Oh yeah, you'll get me with that. What is it? Chevelle, not Chevelle. Cheval, the
Cheval
one that
or
has the
Cheval.
Cheval.
Yeah, yeah, or
Yeah, I've seen the
Cheval.
pictures. Ooh, that looks
Yeah,
good.
yeah,
Anyway,
that's good.
yeah, I know I'm coming to Chicago early October, and then a month later, early November. So let's try to keep it a little warmer. If I don't make it before
Yes,
then, but
fingers crossed.
I'll I'll be there. So the final thing we wanted to talk about, and I know I had some notes on it now, if I can even find where I
You're
put
gonna
them,
talk
just
stocks?
how strong the stock market's been. Everyone, the time we're recording this, S&P's up 15% for the year. Literally, like nobody was looking for that. We actually outwardly have been overweight equities, as we've talked a lot about since late December. We said between 12 and 15% potential gain this year. We're there, right? And we did say, though, hey, get more good news. We could hit an all-time high, only 8% from an all-time high. I mean, it's not as crazy as it sounds. It just, some things to think about, Sona. We just hit a 52-week high last week on the S&P 500. First one in more than a year. What does that
Wow.
mean? 1 year later, S&P's been higher 15 out of 15 times, up over 17% on average. Just think of at that. We talked before a couple of weeks ago about new bull market up 20% off the lows. When you're up 20% off the lows, what happens next? A year later, higher 12 out of 13 times, up again about 17% on average. So if you just look at those two studies, pretty powerful. This rally we've had, what we've been saying for months now is October was likely the lows. Breadth is much stronger. Final, I'll give you three stats. So the third one I'm going to give you, S&P 500 advanced decline line. That's how many stocks go up versus down every single day, cumulative basis out of 500 stocks in the S&P 500. It just made a new all-time high, Sonu. I keep hearing about 5 stocks going up, 7 stocks going up. It's not true. It's not true. We've been saying it for a while. Yeah, those are up more, but a lot of stocks are going up. Industrials all of a sudden are having a really good run. Small caps have had a good run. It's broadening out. So to me, as we're kind of going to wind this down, we've been bullish. We've been overweight. We're still in that camp. You and I are working on our mid-year outlook as we speak. A couple of weeks, we're going to release that, which will be really exciting. But I think, spoiler alert, we still think there's some potential gains to stocks second half of this year, right?
That's a good point. Can you repeat that stat with once stocks reach 52-week highs, what they do 12 months from now?
Yeah. So when you make a first 52-week high with going a year without making one, higher a year later, 15 out of 15 times, not too bad, and up over 17% on average. And that just happened last Monday, I believe, Monday or Tuesday, a week ago. Again, one of those, it is what it is. And then when you look at the breadth, making new highs and different things and all the macro stuff, we just spent the first 25 minutes talking about the positive macro side with some improving technicals and continuing improving technicals. It still suggests, again, being a little overweight stocks makes a lot of sense to us here. Sonu, but again, we are at the end.
Momentum,
small caps,
momentum.
Industrials. Yeah, industrial. What do you? If you had to build a quick portfolio, what would you tilt it to the next 6 months or so?
I mean, equities over bonds. I mean, we generally, you mentioned the overweight, but we like cyclicals. Look, generally we like, you can go put all your money into the S&P 500. That's the easiest thing. I'm not saying it's the easiest thing, but it's a hard decision to make. I think, do you do that? But if you say, you know what, I'm going to put $100 into the equity market. You could say, you know what, I'm going to put that $100 into the S&P 500. And I don't think it's a bad idea, right? Now, we like to think, you know what, you could be more diversified, right? Why just U.S. stock market? It could be international too, right? Next month, I know we'll have Meb Faber on our podcast, everyone. He talks a lot about diversifying outside the U.S. Now, you don't want to get off your skis or anything like that. Or like, let's put 0% in the U.S. and 100%. No. You maybe put 65%, I don't know, let's say 65% or so in the US, 35% international stocks, right? However you want to break that down. And even within the US, why just the S&P 500? Historically, we know that mid caps have done well, small caps have done well too. Maybe you want to diversify that a little bit as opposed to betting everything on the largest stocks literally in the world.
In the
right?
planet,
so on the planet. Yeah. So maybe you want to diversify out, out of large caps. Again, you don't have to go bet the farm on that. You put a small portion of the portfolio in mid and small cap, and we, you and I talk about it. We like it, right? And there are certain sectors we like as well. We still like energy. We think, look, as long as the economy is not in recession, I think energy has to be in the play, one way or the other, right? Other cyclicals you mentioned, industrials. Industrials have things like airlines and industrial conglomerates and things like that, right? Those should do well. Then consumer discretionary as well. We are just talking about, housing. Home builders are within consumer discretionary. Yes, the biggest part of consumer discretionary I recognize are, I don't know if I'm allowed to say the name, so maybe I won't, but you can go look up the largest stocks in the consumer discretionary index or ETF, whatever it is. And you'll find two big names.
Let's not give it away, but sometimes you walk in your house and trip over a box. They brought it to you, and the other one, maybe it's a car that's
exactly
by a guy with a name that starts with an E. I didn't give it away, I don't think, but hopefully
that's it. There you go. Yeah, but then home builders are a big part of the consumer discretionary basket. And we just talked about housing starts, and companies are saying, "Oh, you know what? We are going to sell more new home sales than we expected a month or two ago."
Yep.
Right. So I think that's generally, hopefully that gives everyone a picture of how we are positioned. We're not betting everything. We like equities, but we're not putting everything into the S&P 500 index.
Yeah, the key thing I think is I've seen this. I've got to work with advisors the last 8 years and their clients, and people listen to this. Maybe look at things like this too. Chase the shiny object. Listen, 8 months ago, nobody wanted to touch large cap tech because it was doing
Right.
terrible. Right? I mean, a lot of these stocks were cut in half. Now they've had amazing runs, and great, they've had amazing runs. Maybe things that like small caps, energy, things that haven't done quite as well relative the last 6 to 8 months. Maybe those will be the things. 6 months from now, we'll have done a lot better. And that's, again, how we kind of see positioning our portfolios that we run for our more than 350 partners at the Carson Group. That's how we see the world in our Carson House views. Sonu, we have hit the end of the road. Any final comments?
I'd like to think, going back to the stuff you mentioned about stocks, right? Momentum begets momentum. I think one worry is when things hit a 52, when the market hits a new 52-week high, people are like, oh, maybe we should wait or no, right? But look at your stats. You said it, right? Hey, now is not a bad time to get back in. I mean, maybe over the next week, 2 weeks, who knows what will happen. But generally, it's a good sign that stocks hit a new 52-week high. And I love your numbers.
Well, thank you. And I'll just say this, August, September, October historically aren't all that great for the stock market. I wouldn't be shocked at all if we had a little bit of a pullback, a little bit of consolidation. So just be on the lookout for when that opportunity arises to likely add to equity exposure, which is something we will likely do if that were to take place, the standard fall time, a little bit of a break. But with all of that, everyone, the 39th episode of Carson's Facts versus Feelings podcast with Ryan and Sonu is in the books. Fed, I don't believe you. Thank you, Ron Burgundy, for the amazing quote. Could you imagine Ron Burgundy interviewing Fed Chairperson Powell? I just thought of that, but
somebody needs to. Do they have a meeting on Halloween Day or something? Somebody needs to, dress up.
I listen to the Ron Burgundy podcast. He doesn't do it very often, but every once in a while, does a Ron Burgundy podcast. They need to get Jerome Powell on there. That would be hilarious. Yeah. But anyway, all right, everyone, thank you for listening. Sonu and I will be back next week with the latest edition of the Facts versus Feelings podcast, and I guess we're doing it live from Omaha. No, that's not next week. I'm way off. No, never mind. I'm sorry. I'm looking forward to being in Omaha with you. It's in a couple weeks from now.
In a few weeks, yeah.
I don't even know where I'm going to be tomorrow, let alone next week. So we'll leave it at that. All right, everyone. Thank you. We'll be back soon, though. Take care. Goodbye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.